For 18 months, the AI market traded believing its momentum was unstoppable. That illusion shattered over 48 hours as trillions in market value evaporated. The losses were immediate. The Nasdaq 100 dropped 3.3% in a single session, revealing that even the largest tech companies were vulnerable to a sudden withdrawal of investor confidence. The instability began with two specific catalysts. First, SpaceX, despite its $2 trillion private valuation, stunned debt markets by seeking a massive $25 billion debut bond offering. This request for cash suggested that even the most valuable megafirms require immense amounts of external debt to sustain their current pace of infrastructure expansion. Simultaneously, Alphabet stock fell 5%. A high-profile exodus of elite researchers from Google DeepMind sparked concerns that the company was losing its technological edge in the AI arms race. Combining a massive debt scare at SpaceX with talent fracturing at Google activated institutional sell algorithms, shattering the belief that the AI supercycle was immune to market gravity. The sell-off quickly reached the physical supply chain. Market attention shifted to Micron technology, the dominant provider of the high-bandwidth memory chips required for AI data centers. Traders labeled this the Micron test. There is a growing fear that infrastructure spending by big tech hyperscalers has plateaued, a concern that triggered a 13% sell-off in Micron stock before its earnings were even released. That anxiety moved instantly into the Asian markets. South Korean hardware giants Samsung and SK Hynix both plummeted 13% in a single day of trading. Because hardware dominates the regional economy, these losses single-handedly forced South Korea's KOSP benchmark down 10% from its historic highs. The fear of missing out has been replaced by an active interrogation into whether these massive hardware investments will ever yield tangible returns. Nvidia followed with a 2.8% drop. Prediction markets are now betting that cloud rental prices for AI chips are declining as hardware supply finally catches up to demand from startups. Geopolitical friction is also complicating Nvidia's outlook. US export controls are so tight that banned chips are currently fetching double their retail price on the Chinese black market. Tesla fell 2.7% as broad weakness in the electric vehicle market and job cuts at rival Lucid Group weighed on the entire sector. Tesla faces specific internal challenges as well, including federal investigations into fatal crashes and growing investor division over the CEO's long-term focus. Because companies like Nvidia and Tesla trade at valuations built on optimism, they are the first to face aggressive liquidations the moment market euphoria breaks. The macroeconomic environment is also shifting. Newly appointed Federal Reserve Chair Kevin Warsh has signaled a restrictive, higher-for-longer interest rate path. High rates expose a systemic threat called funding circularity. Tech giants generate revenue by selling AI services to each other and to the startups they fund, keeping capital within a closed loop. This system relies on external debt to maintain its momentum. As interest rates rise, maintaining that debt becomes increasingly expensive. If everyday businesses and consumers do not start paying premium prices for AI tools to inject outside cash into this loop, the entire circular ecosystem will eventually collapse. Within days of the rout, Asian tech stocks began to rebound as institutional money managers stepped in to buy the dip. Historical data from the internet and smartphone eras shows that every major technological revolution faces violent pullbacks on its way to maturity. Market flushes act as a critical release valve, cooling overstretched valuations and shaking out dangerous speculative leverage. The tech sector is entering a phase defined by execution rather than speculative promise. Wall Street is now demanding proof of real-world cash flow, stable capital structures, and actual efficiency gains. The industry's grace period has expired. Moving forward, the market will distinguish companies delivering tangible technical utility from those supported only by circular funding.